The American interest rate squeeze at 5.5%, the federal funds rate is the highest U.S. savers have seen since George W. Bush was sworn in. Short-term Treasury bills now pay more than rental properties in Miami. Credit card APRs flirt with 28%, and Uncle Sam added $2 trillion of new debt last fiscal year, more than the 1980s interest rate shock and the 2008 bailout combined. People feel the tension. Headlines ask whether the Federal Reserve has engineered higher for longer, whether inflation is truly dying, whether the dollar can survive another trillion-dollar deficit, and, most urgently, what ordinary Americans should do with their cash before markets make the decision for them. I refuse to wait for hindsight. Today you and I will dissect the U.S. data, real inflation prints, Treasury yield curves, consumer debt loads, money market flows, to understand why rates rocketed, what cracks have already formed, and how to reposition capital before the next shoe drops. If you stay to the end, you'll walk away with a 5-layer plan that has protected wealth through the 1970s oil embargo, the dot-com bust, the Great Financial Crisis, and the COVID whiplash. Let's get to work. 1. Why the Fed slammed the brakes and kept its foot down. 3 numbers forced Chair Jerome Powell's hand. 9.1% CPI in June 2022, the worst year-on-year spike since 1981. $2.06 trillion federal deficit in FY 2023, double the Congressional Budget Office's early projection. $33 trillion total national debt, equivalent to 98% of GDP. When inflation exploded, the Fed ditched transitory language and launched the fastest hiking cycle in 4 decades. Funds moved from 0 to 5.5% in 17 months. In theory, higher rates tame prices by discouraging loans and strengthening the dollar. In practice, they also jack up Treasury interest expense, crush marginal borrowers, and deflate bubbly assets. 2. The dollar wobbles, but doesn't fall. A 5% yield on T-bills lured $1.3 trillion into money market funds in 12 months, propping the greenback even while BRICS nations talked up a rival reserve currency. Yet currency strength is a fair-weather friend. It evaporates the minute Congress hints at debt monetization or the Fed flashes a dovish pivot. Betting your grocery budget on an ever-muscular dollar is gambling. We need hedges. 3. Negative real rates on checking accounts. July 2023 CPI cooled to 3.2%. Most savings accounts still paid 0.4%. Even after banks chased the Fed upward, the average checking balance earns less than 1/3 the inflation rate. The gap is a silent tax. Earn 2%, lose 3% purchasing power, net minus 1%. Cash is not king. Cash is ice in the Mojave. So leaving excess funds in brick-and-mortar banks is volunteering for theft. We need cash equivalents that either float with CPI or mature before inflation bites. 4. Escape hatch number 1. Treasury inflation-protected securities, TIPS. TIPS adjust principal to the CPI-U index and add a stated coupon. In late 2023, 10-year TIPS offered 2.2% real yield, the fattest since 2008. If inflation averages 3%, the total return approximates 5.2%. Should inflation spike to 6%, you earn 8.2%, outrunning most equity forecasts. Mechanics: buy individual TIPS at auction or choose the ETF SCHP for broad exposure. Ladder maturities 2026 to 2033 to blend liquidity and yield. Rebalance when real yields drop below 1% or rise above 3%. 5. Escape hatch number 2. I-bonds. The retail inflation weapon series I-bonds sold by Treasury Direct combine a fixed rate, now 1.3%, with a variable rate, currently 3.94%. They reset every May and November. The purchase cap, $10,000 per SSN, keeps institutions out, but families of 4 can still tuck away $40,000 annually. Illiquidity. You forfeit 3 months of interest if redeemed before 5 years. But as a 1 to 3 year emergency buffer, nothing matches the government guarantee plus CPI linkage. By near the end of a rate cycle to lock a higher composite for 6 months. 6. Escape hatch number 3. Short-duration T-bill ladder. 6-month Treasury bills hit 5.55% in early 2024. Risk-free, state tax exempt, and immune to price swings if held to maturity. Build a rolling ladder, week by week or month by month. Each time a bill matures, decide whether to roll, spend, or deploy into risk assets after the data confirm a Fed pivot. Cash earns nothing, bills earn 5. That spread, compounded monthly, adds nearly 6% annual cushion to any portfolio. 7. The housing dilemma. 7% mortgages and cracked demand. 30-year fixed mortgages vaulted from 2.9% to 7% in 2 years. Payments on a $400,000 loan ballooned from $1,660 to $2,660, a $12,000 annual shock that froze first-time buyers. Transaction volume fell 25%. Builders offered rate buydowns and free upgrades. Regional banks stockpiled delinquencies. Does that scream 2008? No. Household equity is stronger, underwriting stricter, supply underbuilt. Still, investors expecting endless 20% home appreciation may face a chill. The smart move is to skip bidding wars, hold dry powder, and target distressed sellers, probate, relocation, divorces, where equity cushions your entry price. 8. U.S. equities. Valuation compression hiding inside the index headline. Forward P/E for the S&P 500 sits near 19, inflated by the magnificent 7 tech giants. Remove Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and Nvidia, and median P/E drops below 14. Energy trades at 10, healthcare equipment at 13, regional banks at single digits. Historical data. Anytime the off-megacap cohort fell under 14 forward earnings, 5-year annualized returns topped 11%. Action. Equal weight ETF RSP tilts away from megacaps. Add healthcare dividend aristocrats, mid-cap industrials, and cash-rich tech 2.0 firms trading below 12 times free cash flow. 9. REITs. Buying skyscrapers at 30-cent rate spikes crushed real estate investment trusts. Office REITs lost 60% peak to trough. Even blue-chip residential names yield 7%. Price-to-net asset values hover at 0.65, meaning you buy $1 of property for 65 cents. Risks. Refinancing walls in 2025 to 2027. Mitigation. Focus on REITs that already fixed debt at sub 4% or hold cash for opportunistic buybacks. Examples: cell tower owners, data center REITs, single-family rental aggregators in Sunbelt states with perpetual inbound migration. 10. The federal deficit and why it threatens every portfolio. Interest on U.S. debt now exceeds defense spending. Each 100 BP rate uptick costs taxpayers an extra $320 billion annually. If Treasury supply floods markets while the Fed pursues quantitative tightening, yields jump, growth slows, recession odds rise. Investors must model scenarios: A. Soft landing, rates drop, bonds rally, cyclicals pop. B. Fiscal spiral, rates stay high, dollar wobbles, gold and energy soar. Position sizing, not prediction, wins. Maintain inverse correlation assets: gold, commodities, long volatility ETFs. 11. Protecting purchasing power in an eroding dollar. Since 2000, the dollar lost 41% of domestic purchasing power. You need assets with built-in scarcity or CPI pass-through. Oil and gas pipelines. Regulated tariffs escalate with inflation. Agricultural land ETFs. Farmland rents and crop prices sink to CPI. Royalty trusts. Pay distributions indexed to commodity volumes and sales. Allocate 5 to 7% to such inflation chasers. They counterbalance falling bond coupons in real terms. 12. Behavioral pitfalls. How Americans lose even in good markets. Lifestyle creep. Raises wiping out every Fed hike benefit. Cash drag. $21 trillion still sits in checking and savings under 1%. Retirement loans. Borrowing 401k balances at 6% while funds could earn 8%. Solution. Automate transfers into higher-yield vehicles. Set salary caps that funnel raises into investments, and never raid tax-advantaged accounts unless terminal illness dictates. 13. 5-layer action blueprint. Safety net, 6-month emergency fund split, 60% T-bill ladder, 40% I-bonds. Inflation shield or 25% TIPS ladder, 5 to 10 year. Rebalance annually. Opportunity pool, 15% money market/T-bill liquidity earmarked for distressed real estate or oversold equities. Growth core, 35% equities, 20% broad S&P 500 index, 15% equal weight/S&P X megacap, REITs, mid-cap industrials. Alternative hedge, 10% real assets, 5% gold, 5% energy pipes/farmland ETF/commodity basket. Target beta near 0.75, yield above 4%, and inflation correlation near 0. 14 case studies. When strategy beats fear. Janet, 45, rolled her 2020 stimulus into tips at -1% real yield, then sold at +1% real, capturing 18% capital gain while friends missed one-year CD returns. Marco and Dana, 34, paused house hunt, built 6-month bill ladder at 5.4%, waited. In Q2 2024, they negotiated $38,000 off list from a relocating tech employee, effectively letting the Fed pay their closing costs. Eric, 62, exited growth tech, shifted 30% into pipeline MLPs yielding 8%, funding his Medicare gap entirely off passive distributions. Their secret wasn't market timing, it was discipline layered over data. 15 pushback Q&A. High yields mean I don't need stocks. Wrong. Real yields may retrace. Dividends often climb with inflation. Gold is a pet rock. Central banks added 100 tons in 2023. They're not hoarding pet rocks, they're hedging policy errors. House prices never fall nationally. Adjusted for mortgage affordability, 2024's median payment-to-income ratio equals 2007. Gravity applies eventually. 16 The victor's mindset. Data over drama. Media thrive on fear. Markets thrive on uncertainty priced correctly. Your edge is ignoring clickbait and acting on ratios, spreads, and cash flow math. Ask these Buffett-style questions before any purchase. Do I understand how this appreciates? Does it spin off cash or at least pace inflation? What's my margin of safety if everything goes wrong? Am I overpaying relative to intrinsic value? If any answer stinks, walk away. Conclusion: choose your path before the market chooses it. 5.5% yields won't last forever. Either the Fed cuts, crushing coupon income, or it hikes into a fiscal wall, endangering dollar faith. Waiting for certainty is choosing to bleed slowly. Instead, implement the 5 layers. Open Treasury Direct, ladder bills, buy your first tips, pick a low-fee diversified ETF, allocate a sliver to gold, and promise yourself you'll revisit allocation quarterly, not after every headline. Comment below which liability you're dumping or which asset you're adding this week. And subscribe. Next episode, we break down how a simple 2 ETF combo beat 87% of active U.S. fund managers after tax. High rates shout fear. Disciplined strategy whispers wealth. Which voice gets to run your money?